Hi everyone and thanks for joining another segment of TLA. Breaking down the market structure is crucial. Is essential for both beginner and experienced traders as it helps identify present trends, possible reversal zones, and general market behavior. In this video we'll guide you on how to analyze charts like a pro trader. We'll cover both fundamental and advanced ICT concepts for interpreting market structure and determining its directions. So if that sounds good to you, make sure to hit the like button to support us and don't forget to subscribe if you're new. Catch you after the intro. Define what market structure is. When discussing the concept of market structure, we're referring to swing highs and lows, price action, and the zones the market has highlighted. A previous reaction, we treat all these elements as components of market structure and they form the framework of price movement. Let me walk you through some fundamental ideas of ICT market structure. As you're aware, in a perfect uptrend the market consistently forms successive higher highs and higher lows. Whenever the market breaks a higher high to the upside, it's termed a break of structure, indicating the market's intent to persist in the bullish direction. On the flip side, when the market breaks a higher low to the downside, we refer to it as a change of character, signaling a potential trend reversal. So here's an important point. A break of structure remains valid even if the market wicks above the higher high, and the demand zone it forms presents a legitimate trading opportunity. However, for a change of character, it requires a break and close below the higher low to confirm. Otherwise, we treat the market as still intact as bullish, yet the market shows minimal movement, which clearly. So here's the question: which of these breaks are valid and qualify as a change of character? To answer this, we first need to identify our swing lows. In a bullish scenario, the lowest point between two consecutive highs is recognized as a swing low. Here, we have two consecutive highs, so the lowest point between them is our swing low. As long as the price remains above this level, it indicates a bullish market, and we will focus on buying opportunities. For a valid change of character, we need a candle that breaks and closes below this level. In this move, we have another break of structure, with the lowest point between two consecutive highs identified as the swing low. Once again, we have two consecutive highs and the swing low. Remember, the same concept applies to the bearish scenario. Now, here's another question. When can we be certain that a change of character will signal a trend reversal? To answer this, it's essential to grasp the fractal nature of the market. Imagine we're observing a clear uptrend. On the 4-hour time frame, with a sequence of impulsive and corrective moves, the market consistently forms new higher highs while respecting the higher lows. If you zoom into the 1-hour time frame, you'll see that this 4-hour impulsive wave is made up of impulsive and corrective moves that follow the higher lows in an ideal scenario. But in a less perfect scenario, the price may trigger false breakouts before continuing upward to form higher highs. When traders spot these fake outs, they often assume the price will reverse. They might enter short positions in the supply zone and get stopped out. However, with a deep understanding of market structure, you'll recognize that since the higher time frame is bullish, you should identify an order block and align with the dominant trend. Here's a key point: the best trading opportunities occur when the lower time frame and the higher time frame are aligned in the same direction. Here, on the EUR/USD 1-minute chart. These represent the impulsive and corrective moves we observe. However, when we zoom out to the 5-minute chart, we only see these moves. So, in areas where both the 1-minute and 5-minute charts align, trading becomes more logical. Now that we've covered some basic concepts about market structure, let's move on to the advanced phase. But before we proceed, if you've enjoyed the video so far, please give it a thumbs up and subscribe. It really helps support us in creating more content like this. Also, leave a comment below with topics you'd like us to cover in the future, as we always refer to your suggestions when planning our next videos. When discussing ICT concepts, market structure is all about determining who holds control, supply or demand. The key point is that a valid supply and demand zone must meet 3 criteria. The mitigation or break of these valid levels helps us identify the market direction. The first criterion for a valid zone is that it must exhibit an imbalance. Imbalance refers to an unequal proportion between buyers and sellers, leading to a significant move in the market. The second characteristic of a valid zone is that it must either break the structure or change the character. The third feature is that it must be unmitigated. Supply and demand zones are for one-time use only, so zones that have been mitigated before are no longer considered valid. If a zone lacks any of these criteria, it will not be regarded as a valid supply or demand zone. Now, let me walk you through some of the common ICT market structure patterns and how we approach them when they appear on the chart. The first pattern is known as the market flip. This pattern occurs at the end of trends when they become exhausted, leading to a change in direction. We have a valid demand zone with a break of structure and imbalance. The market mitigates this level but fails to form a higher high, indicating a loss of momentum. This ultimately results in a change of character, creating an ideal trading opportunity. We enter short when the price taps into the supply zone and target the next unmitigated demand level. Here on the AUD/USD, we saw a clear uptrend until the market reached this valid demand zone, which produced both an imbalance and a break of structure, gets mitigated by the market, but is unable to form a new higher high and eventually breaks below. So this marks a valid change of character and leaves behind an ideal supply zone. At this point, we can look for a short entry if the price returns to this order block, with our long-term target set at the next unmitigated demand zone ahead in the market. Next is the well-known liquidity grab pattern, which occurs when many traders mistake a fake breakout for a change of character, but the market continues in the original direction upon reaching a valid supply or demand zone. In this case, there's a valid break of structure but no imbalance. However, looking to the left, we spot a clean unmitigated demand zone featuring both a break of structure and imbalance. So, if the market moves through this level, we don't treat it as a change of character. Instead, we watch for buying opportunities within that demand zone. On the USD/CAD chart, we observed a consistent pattern of higher highs and higher lows. Even though this demand level caused a break of structure to the upside, it didn't create any imbalance, making it an invalid demand zone. Conversely, when we analyze the left side, we identify a clear imbalance that forms a strong demand level, making this change of character invalid in our view. This move is highly likely to be a liquidity grab. So we'll position our buy entry a spread above the order block and aim for the next key level in the market structure. Remember, these types of setups offer excellent risk to reward ratios, and even with win rates below 50%, they can still yield overall profitability. However, it's strongly advised to lock in partial gains when the trade moves in your favor. So take time to apply these ideas to your charts, and hopefully, they'll sharpen your understanding of market structure. If you found value in this video, make sure to give it a like and subscribe if you haven't yet. See you in the next episode.